Now, let us talk about accounting events. Before we can even talk about realization or recognition, we need to understand what an accounting event is. You see, an event is a transaction that alters an entity's financial statement. An event causes a changes in either the assets, liabilities, or equity section of the balance sheet statement. As an accountant, it's part of your job to know when an accounting event has taken place. Some events are very obvious, for example, exchanging cash for a product or service. Some events are less obvious, like, for example, uninsured business loss, losing a lawsuit. These events are often missed in financial reporting because they do not involve an immediate outlay of cash. But however, in the future, cash will need to be paid to cover the loss. Any event that has an economic effect on the assets, liabilities, or equity section must be recorded. Let me give another example. Now, let's say you start a lemonade stand and Uncle Joe comes in and says, "Hey, give me lemonade. I'll pay you 2 weeks when I get my paycheck." And then, so you give him the lemonade, but he didn't give you cash. He just gave you a promise to pay. Well, that promise to pay is an accounts receivable. It has changed. Your structure, your assets, liabilities, equity has changed because now you have an equity transaction, revenue, and then you have an asset transaction, but instead of cash, you have something called accounts receivable. So because there has been a change, something of value has been exchanged, as an accountant, you have to recognize that and record that because that's the only way you keep accurate books. So now let's talk about event recognition. When you think of the word recognize, what comes to your mind? Well, if you looked at a Merriam-Webster dictionary, it will tell you recognize means to recognize something means to acknowledge formally. Well, in accounting, it's pretty much what it means. Recognition means to formally report an event in the financial statements. However, just because we recognize an event does not mean cash exchanged hands. For example, the example I gave with Uncle Joe when he bought a cup of lemonade from you, Uncle Joe has said he had no money to pay at a time, but he promised to pay you when he got his paycheck, when he comes to visit you next time. Uncle Joe buying lemonade from you is a recognized event even though no cash was exchanged. It's important for you to differentiate between the events that actually happen in the business and where cash is collected and the events that happen where no cash is collected. Because where no cash is collected is where accrual accounting comes into play. Because you got to remember, events are good prediction of future cash flow. So, for example, if I did not record the cash that came in the event, Uncle Joe's event, when Uncle Joe comes visit me in 2 weeks from now, I'm going to forget that he owes me money. And, we'll have games, and because I don't have a record. So when he leaves, I remember, oh, I forgot to collect my money. But if I had the record and I had a system of collecting and I was recording that, I can say, oh, Uncle Joe owes me $2. Auntie Sally owes me $2. Auntie Mai owes me $5. And then I have a ledger of accounts receivable, and I can go to those people and say, like, hey, Uncle Joe, you said you pay me 2 weeks from now. You're 3 days late. So that's the whole point of accrual accounting. It's accruing all these events, regardless of cash collection. So one day, the cash can one day be collected, because if you're not accruing these events, it's very, very easy to forget. Now, let us talk about event realization. When we realize an event, we convert the event into actual cash. So let us say you approach Uncle Joe, tell him you're starting a lemonade stand. Uncle Joe thinks your idea is so cool and places an order for 10 cups of lemonade before you even open the shop. In this case, the cash was received before the event. In other words, we realize an event before we recognize it. The recognition of the event does not happen until the actual event takes place, which in this case, it's when Uncle Joe gets 10 cups of lemonade. Uncle Joe is paying for a future transaction. So in other words, we're deferring the income. We'll learn the term unearned revenue, which is deferred income. Basically, we have collected the cash before we provided the service. So this is another basis of accrual accounting. We're either accruing or deferring, because basically we're recognizing cash, because realization has to do use the word wrong word. We're realizing cash before we recognize an event. Now, they're two different things. Cash realization or event recognition are two different things. They don't always happen at the same time. Once you get this, it becomes easier to understand what accrual accounting is about. The recognition principle in accounting means that revenue is recognized even when cash has not been received. This means that revenue on the profit and loss statement will include revenue from transactions where cash has not exchanged hands. However, the service has been substantially performed or the product has been delivered. That means it's been transferred to the customer. In other words, when using accrual-based accounting, your revenue will not match your cash flows from operations because they're two different things. Your total revenue and your cash flow is different because you can collect cash before or after the service, but revenue is recognized when the service is performed or the product has been delivered. It's been completed, delivered, the risk has been transferred to the buyer. At that point, we recognize the revenue. This is known as the accrual basis of accounting. It's the general accepted accounting principle in the United States. The opposite of accrual-based accounting is cash-basis accounting. In cash-basis accounting, transactions are only recorded when cash exchanges hands. This is used by very small businesses for easy record keeping. Now let us see an example. Mary received $500 of consulting services from Joe Inc. in the current month, but promised to pay 1 month from now. Joe Inc. must accrue the revenue because the event has already happened. The account used to hold the receivables for revenue that has been recognized is called accounts receivable. Now, this is an asset account. Joe Inc. has earned the right to the cash. That's what accounts receivable is. I have earned the right to the cash. So the cash is a future benefit to Joe Inc. Therefore, Joe Inc. has an asset. So right now, we record assets equals liability plus equity. We have 500 accounts receivable, which is an asset. We have 0 liability and plus 500 revenue. So remember, both sides of the equation must always equal. In the future, when the cash is collected, cash exchanges hands with accounts receivable. So this is an asset exchange transaction. The original transaction is an asset source. In the future, we have an asset exchange. Now, let us look at an example where we accrue expenses. Here we see JJ worked for Joe Inc. and Joe Inc. will not pay JJ the $800 owed till 1 month from the day the job is completed. Well, Joe Inc. must accrue the expense because the event has taken place. Accrued expenses are normally classified in a payables account. For example, you hear the term accounts payable, but in this case, since the payable is wages, it's going to be classified as wages payable. Payables accounts are liability accounts because this is money the business owes to outsiders for services the outsiders already performed to them. So let's see an example how this will be done in the accounting equation. Here we see our assets equals liabilities plus equity. We have $0 cash has been collected. We have 800 salaries payable plus 800 salaries expense. Now this is called a claims exchange transaction. This was not given because we didn't have, we're only cash basis in Chapter 1. We didn't get to see this term. But claims exchange is an accrual-based exchange, meaning there's only change on the right side of the equation. Nothing happens on the left side. So it's a change between liabilities plus equity. So here we see we're exchanging salaries payable for salary expense. So what happens when the cash is paid? As we can see here, we see there's a reduction in cash of $800. The salaries payable goes down by $800, and the expense account is not affected because you got to remember the expense was recognized after the event took place. Now, this is just an asset use transaction. We're not, expense has already been recognized, so we can't recognize expense twice. But rather, what we're doing is just using our cash to pay down our liabilities. Now, let's move to supplies. Before I talk about supplies, let's talk about what is an asset. You got to remember that a cost is an outlay of cash in exchange for something of value. This was talked about in Chapter 1. A cost can be an asset or an expense. Remember, one of the characteristics of an asset is that it has future value. An expense, on the other hand, is a cost whose usefulness is consumed shortly after purchase. For example, when you buy an ice cream cone, the second you eat it, the ice cream fails to exist. I mean, right? Another way to put it is there is no future value. When you buy the ice cream, you eat it, it's done. But what if you bought a whole bunch of ice cream, and that was like supplies for, something you needed to do for your business, or you bought like office supplies, you bought like a bunch of pens, or you bought, something in bulk. Well, you're not going to use it all up now, so there's still some future value there. So that supply, those items you buy, have future value because it's going to be used up in the future. So a supply is different from a supply expense because supply expense means I have bought the supply and used it up now. A supply as an asset means I have the supply now, but however, I'm not using it now. It's in storage. And as I use it up, then it becomes my expense. So supply is an asset because there's still some future value to it. So what happens when a cost is not immediately consumed but is used for future revenue production? For example, supplies. Well, it's classified as an asset. Assets like supplies that arise from a cost of the business eventually show up on the profit and loss statement as an expense after they're used up in the revenue production process. So in the case of supplies, it will be classified as an asset, and then as it's used up, it shows up on the income statement as an expense. So let's summarize what we've learned about accrual so far. Accrual and deferral have to do with properly accrual and deferral have to do with properly accounting for events even when no cash exchanges hands. So it's about making sure that events is going to change our accounting equation, either our assets, liabilities, or equity, are probably accounted for, regardless of when cash exchanges hands. It makes our financial statements more accurate. We recognize when an event is completed. This is another way of saying a transaction is recorded on the income statement, either as a revenue or expense. We realize when cash exchanges hands. Some events might not be realized or recognized in a given period. However, deferment is still necessary when the business owner is engaged in a firm obligation to exchange cash in the future. We'll see an example very shortly with supplies. Remember I said some events might not be realized or recognized in a given period. However, deferment is still necessary when the business owner is engaged in a firm obligation to exchange cash in the future. Well, let's look at our first transaction. Joe Inc. purchased $800 supplies on account. They have the 800 supplies assets. On account means they didn't pay cash. So they have the $800 accounts payable, which is a liability. So there's no realization here, no cash is exchanged hand, and there's no recognition because remember we said recognition has everything to do with the income statement. We have $0 supplies expense. However, we still defer this transaction because the accounts payable is a firm obligation to pay cash in the future. So what happens when Joe Inc. pays the $800 for supplies? We see our cash goes down and our accounts payable also goes down. We realize the transactions here because the cash, as you can see, cash is exchanging hand. In exchange, we're getting our accounts payable is going down. So what happens when Joe Inc. used up the $500 of supplies? 500 of the 800 they bought. Well, the supplies asset is going to go down. Our equity is going to go down. Our supplies expense is going up, but the equity, retained earnings, is going down. So here we actually recognize the transaction here. Normally, this is an adjusted entry at the end of the period, because then you have to count up the supplies. And notice I gave you the amount that was used up and not the ending balance of the supplies account. Let's move our attention to prepaid expenses. Remember when we talked about assets, still one of the characteristics of an asset is they have future value? Well, when cash is collected before an expense is incurred, we say we have a prepaid expense. And that's because we still have future rights to the service. So when we prepay for something, it's an asset to us because we haven't consumed it yet. There's still some future rights to the service or products we paid for. Let's look at an example. Joe Inc. paid JJ $300 for consultant service to be performed 3 months from today. Here we see cash is paid. We see cash is paid. It's a negative 300. is paid in exchange. Let me make that so you can see that more clearly. Okay. Cash is exchanged for prepaid expenses. It's an asset exchange transaction. You have two assets exchanged in hand. There's no change in liabilities and there's no change in equity. However, in 3 months when that service is performed, we see that our prepaid asset goes down, and at the same time our equity goes down, our consulting expense goes up, our equity goes down. So we did not recognize the expense until the event has actually taken place, which is 3 months from now when the service was agreed to take place. So until that's completed, we have an asset, and when it's completed, it becomes an expense to us. Let's talk about receiving cash before revenue is recognized. When our customers or clients pay us before recognizing revenue, we have something called an unearned revenue. And that's because we have not performed the service or given them the product they have paid for. For example, Mary paid Joe Inc. $2,000 for consulting services 3 months from now. You can see it's kind of the reverse of the prepaid where we're paying somebody else 3 months from now. Here, someone is paying us in advance. So Joe Inc. must defer the revenue because the event has not happened. They have not performed the services. The account used to hold revenue that has not been earned is called unearned revenue. This is a liability account. Why is that so? I mean, it's kind of weird. Like, why is a revenue account a liability account? I know that could be confusing, but it's a liability because we owe that service to the customer or to the client. So until we perform that, we owe them an obligation, and because we owe them an obligation, it's a liability on our part. So because that is still owed, it's a unearned revenue account, a liability account. So let's see an example. Mary paid Joe Inc. $2,000 for consulting services 3 months from now. Well, we can see when this happens. We have our cash goes up. We realize the cash, $2,000. We have the unearned revenue, $2,000, the liability account. So in 3 months, when we perform the obligation, the asset is not changed. Our liability of $2,000 unearned revenue goes down, and our revenue equity goes up by $2,000. So let's summarize accrual and deferment. Why is this important? Why do we even care about this? Like, this seems like too much work. Why can't we just recognize revenue when cash comes in and recognize expenses when cash comes in? I mean, why do we have to go through the trouble? Well, let's make the assumption you hosted a banquet in March. The banquet brought in $1,000 in revenue. However, all the expenses needed to host the banquet occurred in February. The total expense was $500. If you were to print a profit and loss statement in March, it would look like you made $1,000 with no expenses. That would be great, right? But that's not true. However, you know the banquet cost you $500. The matching principle is an accounting principle that solves this problem. That's the problem we're trying to solve. We're matching our revenue with our expenses, so our financial statement looks correct. So when we say we have $1,000 in revenue, we know it cost us $500 to make that revenue. The matching principle says expenses should be deferred or accrued to match its corresponding revenue regardless of when cash is received.